Merrill Lynch, $16.5 million in FINRA fines. All because their brokers skipped one document, the investment policy statement. The clients, retired Puerto Rico residents who lost 70% of their savings on bonds their IPS explicitly said were too risky. The exam tests exactly one thing here. Do you know what standard III requires before you make a single recommendation? By the end of this lesson, you will get every standard III question right. Standard III has 5 parts. Each one is independently testable. Think of it as 5 duties you owe your clients. Loyalty, prudence, and care, that is 3A. Fair dealing, 3B. Suitability, 3C. Performance presentation, 3D. And preservation of confidentiality, 3E. The exam favors 3A, 3B, and 3C. Those 3 together account for the majority of standard III questions. Here is the open loop. One of these 5 has a rule that almost every CFA candidate gets wrong. We will expose that trap in about 4 minutes. Standard 3A. Loyalty, prudence, and care. The core rule is simple: client interests come first. Before your employer. Before yourself. But here is what the textbook buries in a footnote. The prudent investor rule is evaluated at the portfolio level, not the security level. Your supervisor says a junk bond is automatically imprudent. Your supervisor is wrong. A CCC-rated bond can be entirely prudent if it serves a defined role in a diversified portfolio. The old prudent man rule evaluated each security in isolation. The modern prudent investor rule does not. Soft dollar arrangements. This is the standard 3A trap most competitors skip entirely. Here is the scenario. A manager directs client brokerage commissions to a specific broker, and in return, receives Bloomberg terminal access for her own use. She says, better research benefits my clients indirectly. Wrong. Client brokerage belongs to the client. For soft dollars to be compliant, 3 conditions must be met. First, the research must primarily benefit the specific clients whose commissions are being directed, not other clients, not the manager. Second, commissions must be reasonable relative to services received. Third, the arrangement must be disclosed to clients. The indirect benefit justification fails every time. Standard 3B. Fair dealing. The exam tests exactly one thing here. Fair does not mean equal. Read the standard carefully. It says fairly, not equally. When a new research recommendation is issued, all clients must receive it simultaneously. That is the timing rule, and violating it is a clear 3B breach. But when allocating IPO shares in an oversubscribed offering, a manager is not required to give all clients the same number of shares. Proportional allocation based on account size, suitability, and prior indication of interest is explicitly permitted. The Morgan Stanley case. They paid $50 million to the SEC because they allocated hot IPO shares to favored institutional relationships, not because they allocated proportionally. But here is where most candidates get standard 3B wrong. The 45-minute call trap. A manager issues a sell recommendation. She calls her 3 largest institutional clients immediately. Then she emails everyone else 45 minutes later. Is that a violation? Yes. The standards require simultaneous dissemination. An intentional 45-minute gap that gives institutional clients a trading advantage violates 3B regardless of the operational rationale. They pay premium fees is not a defense. It is standard practice, is not a defense. Simultaneous means at the same time. The exam tests exactly one thing here. Read the question carefully. Kara Chen updates her largest clients' portfolios first because they pay higher fees. She notifies smaller retail clients 2 days later. Which standard has she violated? Most candidates say 3A because it feels like a loyalty issue. That is the trap. The correct answer is 3B, fair dealing. The violation is between client classes and the timing of dissemination. 3A covers client interests versus manager interests. This is between clients, and that is 3B territory. Now, most people get this next part wrong. Standard 3C, suitability. Every recommendation must be consistent with the client's investment policy statement. The IPS has 6 components. Use the mnemonic RRLLTU. Risk tolerance, return objectives, liquidity needs, legal constraints, time horizon, unique circumstances. But here is the critical rule for managed accounts. Suitability is assessed at the portfolio level, not per transaction. For advisory accounts, suitability is assessed per recommendation. And there is one rule that almost nobody gets right on the first attempt. Here is the trap that separates beginners from exam-ready candidates. A 68-year-old retiree. Capital preservation IPS. Low risk tolerance. She calls her manager and says, "Invest 40% of my portfolio in a speculative biotech startup." What does the manager do? Wrong answer 1. Execute immediately because the client has the right to direct her own account. Wrong. Wrong answer 2. Refuse under any circumstances because it violates her IPS. Also wrong. The correct answer has 3 steps. Inform the client the investment is inconsistent with her IPS. Document the discussion. Decline to proceed unless she explicitly acknowledges the inconsistency and consents after being fully informed. Client request does not equal suitability. The manager is a fiduciary, not an order taker. This question has appeared on past exams in multiple forms. David Park manages a discretionary account for a 68-year-old retiree with a capital preservation IPS. She instructs him to invest 40% in a speculative biotech startup. What is Park's most appropriate course of action? Option A. Execute immediately, client autonomy overrides suitability. Option B. Inform the client of the IPS inconsistency, document it, and decline unless she acknowledges and consents. Option C. Refuse under any circumstances. Option D. Execute and update the IPS retroactively. The answer is B. Client autonomy does not override the suitability obligation. And retroactive IPS updates are exactly what the standards prohibit. 2 more subsections. Standard 3D, performance presentation. 2 violations appear on almost every exam. Cherry picking, showing only your best performing accounts. Survivorship bias, excluding terminated accounts from your track record. Lisa Wang showed only her 10 best accounts out of 25. 3 accounts were terminated. She excluded them from her brochure. That is a 3D violation twice over. GIPS, the Global Investment Performance Standards, is the gold standard. And for back-tested results, they are permitted if prominently disclosed as simulated. A footnote buried on page 12 is not prominent. A clearly labeled, simulated returns header is. Standard 3. Preservation of confidentiality. Most candidates think confidentiality is absolute. It is not. 3 exceptions, and the exam tests all 3. First, the information concerns illegal activity by the client. Second, disclosure is required by applicable law. Third, the client gives explicit consent. But here is the critical nuance. When a client reveals illegal activity, the correct first step is not immediate external reporting. The correct first step is consult your firm's compliance department and legal counsel. Consult compliance first is almost always the correct answer when confidentiality meets potential illegal activity. Memorize this as your default pattern. The exam will present this confidentiality trap in multiple forms. John Adams discovers his client Robert Chen is using insider information to trade stocks. What should Adams do first? Option A. Maintain confidentiality because all client information is protected. Option B. Immediately report Chen to the SEC. Option C. Immediately terminate the client relationship and report to regulators. Option D. Consult his firm's compliance department and legal counsel. The answer is D. Confidentiality is not absolute when illegal activity is involved. That eliminates A. But immediate external reporting without consulting compliance first is also wrong. That eliminates B and C. Whenever you see confidentiality plus potential illegal activity, the answer is consult compliance and legal first. One more question, and this one trips up nearly half of all candidates. Thomas Rivera evaluates whether to include a CCC-rated junk bond in a client's diversified portfolio. His supervisor argues this violates the prudent investor rule. Which statement best reflects the prudent investor rule? Option A. Junk bonds can never be included under the prudent investor rule. Option B. The prudent investor rule is applied at the portfolio level. A high-yield bond can be prudent if it serves the portfolio's overall objectives. Option C. Any investment a client requests is prudent by definition. Option D. The rule prohibits speculative investments regardless of portfolio context. The answer is B. The supervisor is applying the old prudent man rule, individual security level. The modern prudent investor rule is portfolio level. The word prudent does not mean conservative. It means appropriate for the portfolio's objectives. Save this. This is the standard III cheat sheet, 7 rules that cover every exam question on this topic. 3A, client first, portfolio level prudence, soft dollars need direct client benefit plus disclosure. 3B, simultaneous dissemination, fair not equal, proportional IPO allocation is compliant. 3C, IPS required RRLLTU. Discretionary accounts are portfolio-level suitability. Advisory accounts are per recommendation suitability. Client request does not equal suitability. Flag, document, require informed consent. 3D, no cherry-picking, no survivorship bias, back-tested results need prominent disclosure. 3. Confidentiality has 3 exceptions, ill. First step when illegal activity is suspected, consult compliance. If this was on your exam tomorrow, you would get it right. Three strategy rules that will save you time on exam day. Rule 1. When you see allocation, IPO shares, block trades, recommendations, ask 2 questions. Was dissemination simultaneous? Was allocation based on legitimate factors? Both yes, likely 3B compliant. Sequenced by client size, violation. Rule 2. When a client requests something, the answer is never comply without suitability review. Always flag the IPS inconsistency first. Rule 3, when you see prudent, think portfolio level, not security level. And when confidentiality meets illegal activity, the answer is almost always consult compliance first. Standard 3 questions average 90 seconds each. Use process of elimination. Any answer that says comply immediately when a client requests something unsuitable is wrong. Any answer that says equal treatment required for allocation is wrong.